Hey, this is Thomas. Let's talk about what happened to the market recently and what can we do about it. Since the beginning of the year, the stock market has been on a pretty bumpy ride. No matter it's the US market, the Canadian market, pretty much the drop since year to date has wiped out all the gains from the late 2021. Individual stock like Shopify, the recent crowned Canada's biggest publicly traded companies, has tumbled 25% since the beginning of 2022. On Netflix, it's pretty much 15% off since last year, and the Nasdaq had its worst week in the early January since 2020. Many people fear this is the beginning of the bear market. Others say it's a good time to buy some quality stocks at a discount rate. What should we do then? And can we make a profit in 2022? So I will share my 2 cents about why the market is like this and some of the strategies to get through this wave. Disclaimer though, any advice in this video is for your general information. You should talk to the professionals about your specific situation before making any financial decisions. So let's get started. As with any market volatility, there must be more than one factor to contribute to the roller coaster ride. In simple terms, I sum it up into 4 factors. The uncertainty of COVID has of course played a part. While the Omicron virus hasn't hit people as hard as other variants, it is certainly spreading rapidly, causing concern, in some cases panic. In addition, COVID is still causing the supply chain issues and staff shortage across the board. Many financial analysts predict that we could open up the economy in Q4 last year, but with the most recent strain, unpredictability has caused more restrictions and uncertainty. Many people thought they would be traveling by this time, but with the new variant, many people have opted to stay home. This hasn't just impacted the travelers. Airlines, hotels, and resort locations thought they would see the return of customers, but instead have had to scale back and reduce their service. While supply is low and demand is high, then business owners will increase their price, which leads to the next factor, inflation. As prices rise, your dollar won't purchase as many goods and services as it used to. But hey, inflation itself is not necessarily a bad thing. It depends on how fast and how far it rises. On one hand, inflation can be an indicator of a growing economy, often translating to more jobs and rising wages. As this occurs, consumers have more disposable income to spend on more goods and services. A moderate level of inflation is generally good for the economy, which is why the Bank of Canada's target inflation rate is around at 2%. But when inflation rises too fast, wages don't keep up and things cost more, meaning people have to spend less, which can drive economic growth. To measure inflation, Statistics Canada uses something called the CPI index. CPI stands for Consumer Price Index and is a way to measure the price of everyday item over a period of time. This way, the government can track inflation and see how it affects consumers. These reports recently show that the CPI increases at an annual rate of 4.8% and grocery prices increased by 5.7%, the biggest annual gain since 1991 according to a CPC report. Inflation can eat away at a company's profit, as they may have to absorb at higher price and slower sales, less profit margin, which often causes the share price to dip. Therefore, they will have to raise the price again, which leads to another inflation. Therefore, the government has to do something to keep the inflation in check. Now, interest rates are one of the tools that governments use to fight inflation. In simple terms, when interest rate increases, the cost of the borrowing will also increase. Therefore, the market will think twice for their action because they have less ammo in their bank account. And especially for tech stocks, because they all operate on debt. So when interest rate increases and their performance don't meet the expectation, then pretty much it's plummet time. An example of this would be Netflix, which has typically earned good rates of return for its investors, but recently it has shattered almost 50% of its price, returning to its 2019 performance. Netflix has over $15 billion in debt and almost $29 million in liabilities as they competed against other streaming services to make high production content. Now wait a minute, you'll probably be thinking, hey Thomas, what about the growth stocks that don't take on a lot of debts like Amazon, Apple, or American Express? Why are they seeing crazy market fluctuations when they don't have as much debt? Well, when countries all around the world started to print money, we knew that inflation was coming, but we didn't expect it to catch up with us quite so quickly, which is part of the reason why the market has been so volatile recently. So when you combine all the news together, it leads to the ultimate reason, which is uncertainty. At the end of the day, the stock market doesn't mind bad news. What the stock market hates is uncertainty. When things don't meet the expectation, the market do drop, which is fine because it can be digested. But when you don't know what to expect, then it creates fear, and that really causes volatility. It's kind of like when a wife asks her husband what time will be home for dinner. There are only 3 scenarios that can happen. If the husband is always on time, great, everyone is happy. A worse scenario, say dinner is 8 p.m. but the husband came home at 9, dinner is cold and wife is upset, but at least they can do something about it. The worst scenario, the wife asks if the husband can be home for dinner at 8, but the husband never answered, being flaky about it and even stopped replying to the wife's text, and that makes the wife worry, anxious, and go nuts. And the stock market is just the same. One of the problems is the American government has been inconsistent with its plans, causing uncertainty among investors. Last year, the US anticipated there will be no rate hikes in 2022, but then they changed their mind and signaled that they will raise the interest once in 2022. Then in December last year, the government changed their mind again and said they will raise the interest rate again for 3 more times in 2022. Therefore, a lot of investors feared uncertainty and pulled the funds. Alright, so more importantly, is this really going to continue and the beginning of the bear market? Well, here's my other 2 cents. I call it the mom and the toddler theory. Let's say mom is the government while the toddler is us, the investor. The mom, of course, wants to protect the toddler and ensure he grows up strong, happy, and healthy. So mom will do her best to create a safe environment and maybe constant monitoring the situation. But in the last 2 years, the toddler has been sick, so the mom told the toddler he cannot go out and play anymore. He needs to be in the room and rest. Meanwhile, the mom keeps feeding him with candies and medicine, aka low interest rate and money being printed non-stop. But now it's 2022 and the mom thinks the toddler should go out to the sunlight, be strong, so she decides to cut back on the candy and medicine, aka raising the interest rates. Now of course, the toddler is not going to be happy about this and kicks up a fuss, but eventually the toddler will adjust and go back to his old way of life. This is kind of the stage that we are in now, the adjustment stage where we have to wean ourselves off to government subsidy, as it seems like COVID will coexist with us. Now, can the mom make a wrong decision? Maybe. But she knows if the kid stays in the room for too long and gets spoiled with candies and medicine, it's going to be even worse. And tied up with candies and medicine strategy has happened a few times back in the last 10 years. And look at us now, stock market has been a historical high. So barring unexpected world events, a new strain of COVID or some other unknown danger, what can we do then? In times like this, I always like to recap the 4D principle. The first D is discipline. As in remember your investment goal. If the current investment you have is for long term, like say retirement in 20 years, then technically this doesn't concern you because you don't need the money now. And here's the example. If you start investing $10,000 from 2003 to 2018 and never miss a day, then you will make $30,000 with a 7.77 return. But if you miss the 10 best day of the whole 15 years, then you will make $5,000 more only with a 3% return. And if you miss, say, the market 40 best days, and you will lose money with a negative return. And that's why I always say your time in the market always far better than timing the market. The second D is diversification, and I have 2 ways to define this. From a macro perspective, is all your investment in the stock market? Do you have emergency fund, saving account, real estate, insurance, or commodities? Different asset classes that helps you to reduce your risk. And from a micro perspective, how diversified is your stock portfolio? Are all of your stocks in one area like tech or US stocks? And if they are, it's time to diversify. The third D is dividend assets. As we learned, interest rates can hurt growth companies, but for banks or energy companies, they don't hit as bad and they're still able to yield dividends to their shareholders. These types of companies should not fluctuate too much in the stock market. And the last D is dollar cost averaging. Again, we don't have the crystal ball, we cannot predict how the market goes. It has been proven that consistent investing over the long term is the best way to increase your money with a lower risk, because it's almost impossible to predict what the best days to invest are, especially for the average investor who doesn't have the technology or the information that large hedge funds use for their clients. So be consistent and invest the same amount of money like an automatic deposit every month or bi-weekly. That way, when the market is low, you're able to capture more units, and when the market is up, your unit you have will worth more. Let's be honest, 2022 has a rough start, but doesn't mean we should just live in fear. Focus on your strategy, avoid unnecessary social media, and maintain a good health so we can remove the fog and mirror to enjoy the opportunities that comes after the wave. Alright, thanks so much for watching, and as stated before, this is just my 2 cents. Make sure you think it through and talk to a professional before you take action. And don't forget to hit the like button if you found value in this. Hey, this is Thomas, and I will see you in the next video.